After the high-profile collapse of SVB, Signature Bank, and First Republic, the stability of the U.S. banking system is still very much in question. The Wall Street Journal this week reported that large lenders in the U.S. may face a 20% increase in capital requirements in the aftermath. Risk weighting is one way that regulators keep tabs on the system. But in a recent piece, our next guest said there are no riskless assets anymore, and maybe there never were. Joining us now is John Heltman, American Banker's Washington bureau chief. And John, of course, my brain immediately goes to treasuries, right, which are sort of the classic riskless asset, but in fact turned out not to be riskless in a rising rate environment. So how should we as investors and media who covers it, how should regulators think about what's on bank balance sheets now?
Just to thank you for the question, and just to kind of like set the table for what we're talking about here. Bank capital is complex, right? So it's not just it's sort of reflected as like you need to have X capital meet that and you're good, which is kind of how it works. But there's lots of different ways of slicing and dicing capital. One of the sort of advents of the several recessions ago, or several bank crises ago, was the Basel Committee, and they introduced this concept of risk weighting assets. And that is sort of acknowledging that some assets are riskier than others, right? So if you are doing a strip mall in Cincinnati that has one kind of risk profile versus a mortgage versus a treasury security, right? And the idea is that you need to hold less capital, or the capital you hold is commensurate with the risk of the underlying asset. But these that sort of risk profile metric has a pretty bad track record. And so to answer your question, like, you know, treasuries were the safe asset this time. If you go back about 10 years, it was sovereign debt. If you recall, in Europe, the sovereign debt crisis around 2011, mortgage-backed securities were seen as very riskless leading up to 2008. So my point with the piece was just that maybe we shouldn't assign zero risk weights to anything, because those things tend to get loaded up in the system and then tend to go boom.
So what does this mean for the broader environment in financial conditions right now?
I think that if policymakers were to take me up on my offer, well, the net effect would be higher capital requirements at banks, because right now there are things that they don't really have to retain capital against. Treasury is a good example. I mean, the most liquid thing in the world is cash, or supposed to be. But, you know, then again, we just got past a debt ceiling crisis that would have deeply affected the value of cash. So, like, as I said, nothing is really riskless.
If regulators sort of change capital requirements, or at least broaden the banks that would have to abide by certain capital requirements, does that then sort of take care of the how risky are the assets kind of situation?
Well, I mean, not really. Like, yes and no. I think there's still a place for risk weighting to exist. It is still true that there are things that have higher risks relative to other things. And it is right for regulators to assign higher capital requirements for those things. And if you're a bank, you can decide for yourself how much risk appetite you have. And, you know, risk equals growth. So, like, if you don't take any risks, then you don't have any growth. So each bank can decide for itself, to some extent, you know, within reason, how much risk it wants to assume. But I think that the idea that there are some things that are just safe, it has a pretty bad track record. And those things, when things are considered safe and you don't have to hold capital against them, then it makes sense for you to hold more of those things. And when everyone's holding the same thing, those values can go up. And when that value exceeds the underlying kind of secular value of an asset, as we saw with treasuries, you know, banks got a bunch of deposits, needed something to do with it, and they put it in something safe, which is long-dated treasuries. The interest rate environment changed, and they found themselves underwater. So yeah, that's kind of the gist of the point there.
American Banker's Washington bureau chief John Heltman. John, always a pleasure to get some of your insights and perspective around the industry. Thanks so much for breaking this down for us.
Thank you.